Senior Portfolio Manager at InvestNow, and welcome to March 2024's InvestNow Market Wrap-Up. At InvestNow, one of our guiding principles is to stay informed but avoid the noise. We know that financial markets can often feel unnecessarily noisy and complicated. With so many headlines clamoring for our attention, it can be hard to keep up with what's relevant and what isn't. But don't worry, InvestNow is here to help. Each month, together with one of our expert fund managers we have on the platform, we'll distill the key events in the wide world of investments into digestible bites curated for the Kiwi investor. Today, I'm joined by Paddy Brown, Chief Investment Officer at Mercer New Zealand, one of the leading fund managers we have on InvestNow. Paddy heads up the Mercer New Zealand investment team, which is responsible for managing over $15 billion of assets for Kiwi investors, including the former AMP Capital turned Macquarie funds, which are now under the Mercer umbrella, and their global expertise, which manages over $400 billion in assets. Paddy has a long career in investment, holding senior roles including at Credit Suisse and BlackRock, which has taken him around the world in London and Sydney before finally returning home here in New Zealand. Paddy, thanks for joining us today, and it's good to be home, right?
Thank you, Jason. Good to be here, and very good to be back in New Zealand after a while.
Yeah, that's right. I mean, Warriors are doing well, so definitely can't complain about being New Zealand, right?
Absolutely.
Cool. So let's kick into the March market wrap-up then, shall we? Because it's certainly been a busy month in market. So, Paddy, March has come and gone. We've got this market dashboard here, which handily summarizes the performance of a few key indices, like global as well as local shares. And we see that international equity markets continued their strong momentum in 2024, while fixed interest finally joined the party, finishing a month higher for the first time this year. Were there any particular pockets in the market that stood out to you, Paddy?
Yeah, I think, Jason, it's good to see that New Zealand equities have finally started to perform again. They've really lagged global markets over a number of years, and to see performance in March actually coming back is good after a very long-term hiatus. And I think if we look at the New Zealand equity markets, it's really back to where it was pre-COVID level at an index level, whereas most other markets around the world, other equity markets around the world, are testing new highs. So good to call out that equities have rejoined the party again. I think we're looking at some of the tech stocks and the Mag 7 in particular, which dominated equity returns in 2023. We're starting to see this year a lot more of a divergence in performance of those stocks. So it's becoming a bit more of a stock picker market, but albeit growth assets have performed very, very well in March and very well year to date, following on that trend that we saw in 2023.
Nice, thanks, Paddy. And kind of delving into your point there, so we can see from this chart that equity markets have been on a banger, not just in the month of March, but really the whole quarter of March. And this expands not just to, the S&P 500, but also to the wider Russell market, emerging markets, NASDAQ, Dow, everything's basically up. So, Paddy, could you maybe give us some insight into what's been the main drivers between the markets seemingly catching fire this quarter? Has it been a repeat of what we saw in 2023, where performance was dominated by just a handful of names like the Magnificent Seven you mentioned before, or are we seeing kind of a broader market lift? What's been happening here?
Yeah, I think as you can see from that broad range of index, Jason, the market has become a lot more broad-based in terms of its recovery this year, but particularly in March, and that's very, very strong performance we've seen across a very broad range of indices in March. Obviously the jury had been out for most of 2023. About would the US achieve a soft landing? Would rates start to come down? I think a lot of investors this year really have been focusing on rates falling or inflation being under control and allowing central banks to start bringing down rates. So the growth assets have been performing very, very well. Obviously, as we come into April, there's been a little bit more volatility in markets and a bit more profit taking and markets falling.
Nice. And speaking of interest rates and kind of diving into the bond market a little bit, so kind of the two key events we saw in March was first, the Bank of Japan, which finally ended its negative interest rate regime. they basically hiked rates for the first time in 17 years. And then kind of contrasting that, 2 days later, we saw the Swiss Central Bank, which was the first developed bank in the world to actually start cutting rates. So it's almost two ends of the spectrum here. Paddy, maybe could you walk us through what some of these key data releases and thinking from central banks mean when it comes to maybe like other developed nations like the US or Australia or New Zealand? Which way are we heading? Are we going to see another hike? Or are we going to see another cut? Are we team Japan? Or are we team Switzerland here?
Yeah, Jason, I think we are starting to see divergence in markets here now, and you've pulled out two good examples there on that slide. Of one large economy raising rates, and another being the first developed economy to cut. But we do think that economies are recovering at different speeds. All eyes really are on the US economy, the world's largest, and it does. There has been probably a market consensus that cuts would be priced in this year. I think given some of the more recent inflation data we've seen in the US post month end, that is being pretty redebated again in terms of where those cuts might come through. And we've seen equity market volatility post the end of March, which represents that. I think the probably consensus view is that inflation is starting to become it's starting to be perceived as more sticky than had been previously thought, and that will push out rate cuts or the ability of central banks to cut rates. I think on the other hand, markets like New Zealand, clearly we're in recession at the moment, and the central banks will be weighing up the impacts on inflation versus the recessionary headwinds that the economy is facing. And it's going to be a juggling act for those central banks in terms of when they do cut and how deep they cut when they start cutting.
Yes, yeah, a great insight, Paddy. So maybe let's dive a bit deeper into New Zealand specifically. So obviously the key kind of headline grabber over the month of March was New Zealand finally entering or re-entering a recession. So that dreaded R word. So that's given by 2 quarters of negative GDP growth. So Paddy, what does this mean? If you're the average Kiwi investor, now that you see New Zealand in a recession, does that mean you sell all your New Zealand shares and go straight into Bitcoin, the best performing asset class so far? Or what does this mean in terms of your the average investor strategy? Does this really move the dial, or is this more business as usual?
Yeah, I think, Jason, New Zealand is in recession, and that's a scary word to a lot of investors. We are seeing a lot of headlines about job cuts, particularly in media and public service.
Yes.
We are seeing a cost of living crisis. Families out there are doing it tough in New Zealand at the moment. So it clearly is a challenging domestic environment. But I think if you're looking at the New Zealand stock market, the New Zealand stock market doesn't really reflect the broader New Zealand economy. We have a handful of very high growth companies which are very much focused on global markets and have very little look through to the New Zealand economy. But the domestically focused names in the economy are very much non-discretionary, utility focused, and very resilient stocks, very strong dividend payers. They're power companies, for example, and essential services that will perform as they should, despite whatever the macro economy in New Zealand is doing. You're going to start seeing, you're going to still see relatively good performance from these names and sustained dividends being paid by these stocks. So I think investors really need to look through the headlines. I think the markets already have looked through the headlines, and as I mentioned earlier in our conversation, the New Zealand equity market has been flat, effectively. It's hardly got anywhere above where it was in 2020, with other markets around the world are testing all-time highs, and Bitcoin, as you mentioned previously, at an all-time high. So long-term investors, I think the adage really is the time you have in the market beats trying to time the market on most occasions. So be very careful chopping and changing investments.
Absolutely, yeah, and it really aligns well with one of InvestNow's kind of key principles, which is obviously we spoke about being aware of what's happening in markets, but avoiding the noise. So a lot of the time, kind of the word recession gets a lot of headlines because obviously people latch onto them and start clicking onto the New Zealand Herald or wherever. But if anything, actually, the fact that we're in a recession may actually be a case of bad news is good news in the sense that we can kind of see here on a per capita basis, actually, the New Zealand economy has done a lot worse. We've been bolstered really by net migration coming through, but you can kind of see here that we've actually had negative quarters of GDP growth since late 2022. So this could be a good news because potentially the RBNZ could be looking at the New Zealand economy. And to your point, Paddy, a lot of Kiwis are actually struggling, and that could be a case of interest rates coming down sooner rather than later. Do you have any views on that, Paddy? I think RBNZ kind of sees 2025 as the first rate cuts. Do you agree with them, or do you see it earlier?
Yeah, nothing we forecast, Jason. But well, I think, yeah, as you say, the Reserve Bank will be looking at inflation, but they'll also be looking at the contracting effects of existing rates, higher rates on the New Zealand economy, and it'll be a trade-off that they'll be balancing as they look through. And the deeper the contraction in the economy, which can be partly attributed to higher rates. That will be very much in the Reserve Bank's focus. And as the economy does contract, it makes a case for reducing rates earlier. So we would expect that we're probably at the top of the rate increase cycle, or very close to the top if we're not, and the next direction would be downwards.
Nice, cool. Let's jump into the chart of the month then, Paddy, and this is straight from you guys from Mercer. So this is Mercer's periodic table of annual investment returns, which provides some really good insights in terms of which asset classes have done well over the years. Paddy, do you want to kind of walk us through this table and kind of what's the key insight that you got out of it?
Yeah, sure. And Jason, this is it's a bit of fun that we pull together on a annual basis, and we color code 16 different asset classes, and these are asset classes that Kiwi investors and generally have access to. So some of the more mainstream asset classes, which we have access to, and what it does show with that color coding is that last year's winner can be next year's loser. So to your point before, let's not jump out of an asset class which is underperformed into an asset class which might be at the top of its performance run. Diversification is absolutely key for investors in this market. You need to be, if you want to grow your wealth over time with the lowest risk possible, you want to be in a broad-based, diversified portfolio. And I think this chart really brings that premise to life. That if you, it's very, very hard to pick the winners year to year, but growth assets generally dominate over that long-term period. And if you're focusing on those 10-year numbers there, you can see very strong returns from the growth assets. And by growth assets, I mean private equity, global equities, Australasian equities, listed property, listed infrastructure, and so on. The safer asset classes, your cash, bonds, and so on, tend to perform lower over that long-term cycle. They're a very, very important part of diversification in your portfolio, and particularly if you're already in retirement or close to retirement or close to needing to withdraw your funds to buy your first home, you want to be moving into some of those lower risk categories. But over a longer term period, the returns provided by those asset classes are or have been lower. So investors with a long-term horizon, just need to be cognizant of that and take appropriate risk with their portfolios.
Yep, perfect. And same thing as you. One of the key things that really stood out to me is just how potentially volatile certain asset classes can be year to year. So, look at commodities, best performing asset class just in 2022, and then 2023 right at the bottom. And it's not just limited to them. It's not just limited to a 2-year kind of horizon. As you kind of see something like global equities, which was top of the rankings in 2023, had a bit of a roller coaster ride. Right, it's no 1 year where it's just consistently at the top. And this is one of the biggest asset classes that investors can invest into. So kind of what does that tell us, Paddy, in terms of just being invested across asset classes?
Yeah, no, I think, Jason, don't try and micromanage your portfolio. I think you put a lot of thought into setting up your portfolio in terms of achieving, very strong diversification. You don't want to be in one stock or a handful of stocks. You want to be in a broad-based index for the majority of your portfolio. Make your choice whether you're investing actively or passively. Different investors have different beliefs. Active investment has been challenged recently, but over the long term, in most asset classes, active managers have ability to deliver alpha over and above fee levels. And look for different asset classes to invest in. So diversification is absolutely key, and by diversification, you want to be looking at low correlations between asset classes. So typically investors will look at something like a 60-40 portfolio, where 60% of the portfolio is equities, 40% is bonds. In most years, there's an inverse correlation, and by that I mean when your equities go up, your bonds go up by less. When your equities fall, your bonds are still positive, and that can actually offset returns, some of those negative returns in bad years, by your bonds performing well. We didn't see that in 2022. That was one of the very few rare years where bonds actually sold off as well, but generally bonds and equities provide quite a good correlation or net negative correlation and diversification benefits. But investors should also look at other asset classes. We do like some of the private market asset classes for those investors who have the ability to think long term, have long term lock up in these asset classes. We want to make sure when you're investing in private markets that you're well diversified. You're not just buying units in a fund which holds a single building, leased to a single tenant. You want to make sure that it's very well diversified in terms of some of those private market exposures, or a private equity fund which has very, very narrowly focused. You want to make sure it's broad based, and ideally across multiple different vintages of private markets. And you can see that the private market returns over 10 years have been top of the table. They've performed very strongly. But it's a long-term lockup. It's not for trading asset classes. But I think the key message to take out of this, be well diversified. Set your strategy and stick to it. Don't get scared by negative performance. Focus on those 10-year numbers. The asset classes do perform well and do what they're supposed to do over that long-term period. If you're worried about very high valuations currently in the market, then you might want to be gradually investing into the market or into certain asset classes and reweighting your portfolios as opposed to going in one go. So feeding money slowly into the market.
Beautiful, Paddy. Your music to my ears. All those words are long term. You stick to your strategy, diversification. Those are all the stuff that we always harp on about in InvestNow in terms of our key core investment principles. So yeah, brilliant stuff, Paddy. Cool. Maybe one final question on this. I was wondering, who decide which asset classes you put on there? Because I'd be interested to see kind of where Bitcoin or crypto is kind of sitting in there, because it's probably the best case of things going up and down, but potentially having some good insights, not just for retail investors, but also probably your institutional investors as well. Because especially with these days, you can get Bitcoin into ETF products. It's all highly kind of institutional adopted these days. So could we potentially see some changes to this graph in the years to come? Or
I'll flip back to the previous slide, Jason. We can talk to that.
Yep.
So let's look at the asset classes again. And if we're looking at Bitcoin, it would have been either top of the table or bottom of the table in every year there. So it's effectively like choosing a single stock, investing in Bitcoin. You don't have a lot of diversification there. It's as you did mention, we are starting to get more participation and more institutional participation in Bitcoin, but it's still at very, very low levels. So this does look at asset classes which have a long-term time history, which have significant institutional and retail investor participation. But Bitcoin for us is not there yet for a number of different reasons. But investors looking at Bitcoin, we really do need to be aware of the volatility of that asset class and be prepared to wear that volatility. So scale your investments appropriately if you're looking at these very, very, very volatile asset classes.
It's great remark there, Paddy, because I know Bitcoin is definitely in the headlines as well. So it's kind of similar in the sense that hard to, figure out which was noise and which is actually a good long-term investment. Cool, but I guess jury's still out on that. Great stuff, Paddy. So that's a bit of a wrap then on the market wrap-up today. Paddy, do you have any closing remarks for us? I mean, we're still early in the year, another 9 months before the end of the year.
Yeah.
Do you want to get out your crystal ball and talk about what's going to happen?
Yeah, I think Jason, if you're looking at our periodic table, the winners from last year, don't tend to be the winners for many years in a row. So some of those asset classes which have been beaten up, I think probably have some room to recover. I won't pick the timing of that, but if we're looking at asset classes like listed property, for example, it's pretty beat up at the moment. There's a lot of negative headwinds and negative media about people working from home continually, office vacancy. There's a lot of other stories in that asset class though, and we do think that listed property is probably unnecessarily beaten up over a multi-year period. Likewise, emerging markets. We think the valuations of emerging markets are far less stretched than they are in developed markets. You obviously are taking different risks with emerging markets, but for those with investors with a well-diversified portfolio, we probably do see better valuations in emerging markets than we do in developed currently, albeit it's a small part of your portfolio, not your whole portfolio. So I think have a good look at value as well as recent strong returns.
Beautiful, great stuff. Thanks so much, Paddy, for your time today. If you guys want to check out more from Mercer and all the great InvestNow.co.nz, where you can find out more and invest into the 23 different Mercer funds that are offered on InvestNow, including 7 within the InvestNow KiwiSaver Scheme. If you want to check out the written market wrap-up piece accompanying this video, check out the link on the screen. Paddy, thanks once again. Great insights, and we hope to see you again soon.
Thanks very much, Jason. Enjoyed our chat.
Cheers. Thanks everyone for your time. We'll catch you next month. See ya.